Guys, it's a new year and a lot of people are giving up on these unicorn high flying stocks with no earnings that are down 70, 80, 90%, the kind of thing that's in the Kathy Wood ARK ETF. When the high flying, no earning stocks are not making money anymore, or worse, losing money, people all of a sudden start to get conservative and look to slower blue chip stocks and dividend stocks and that kind of thing. And so one of the investing strategies that a lot of people start to look at are things like the dogs of the Dow. So I'm going to talk about what the dogs of the Dow strategy is, the stocks that are in it this year for 2023, and I'm going to look them up on a chart and see if I think that they are decent buys or if there are some other stocks in the Dow that would be better buys than those dogs. And the reason I say there may be better stocks is because the whole strategy of dogs of the Dow is just taking the 10 highest dividend paying stocks in the Dow Jones Industrial Average on the first of the year and equally weighting your purchases of those 10 and then waiting the whole year and doing the same thing the next year if some of those stocks no longer qualify for being the highest 10 dividend stocks. But there are 3 stocks in the Dow that do not pay any dividends currently. And so just because they don't pay dividends doesn't mean that they won't be a good returning stock for the year. So let's go take a look at the current dogs of the Dow for 2023. So first, let's see how the dogs of the Dow performed in 2022. So the total return was a positive 2.2% versus the Dow Jones Industrial Average return of minus 7% and the S&P 500 return of minus 18.2%. So it did a lot better than both of them. And a lot of that had to do with Chevron and oil stocks and Merck, which was up a lot on the year, as well as Amgen. So all of these stocks are going to remain for the 2023 dogs of the Dow, except for 2 of them. So Coca-Cola and Merck will be replaced with Cisco and JP Morgan Chase. So should you follow this exactly, or are there some better stocks to buy in the Dow that maybe aren't yielding as big a dividend? Now, a stock usually has a high dividend yield because the share price has been going down. So as the share price goes down, the dividend yield you get goes up. And so that's probably the main reason for these criteria being the 10 highest yielding stocks, because those are most likely the ones that have fallen the most during the year. But that's not always the case. And then you also have these 3 stocks here that have no dividends that also might be good candidates to be long for 2023. So if you sort the Dow by the yearly performance for the last year, you see Chevron, which is one of the dogs of the Dow, and Merck. They had very high returns, as well as Amgen, which is a dog of the Dow. But if you sort by the biggest losers for the year, you'll see something like Salesforce and Walt Disney, which are both Dow components and have a big down year, but have no dividends, so they are not included in this strategy. So let's just go through all 30 of these Dow stocks and see which ones look like they are bottomed out based on the stochastic and the MACD on a monthly chart, a weekly chart, and a daily chart. I'm going to be looking mostly at the monthly chart because that time frame matters more on a yearly basis. So looking at Verizon, which is the highest yielding one, it was as low as 34. Now it's close to 40. I would say this has a good chance of having a decent return for the year. And then when you add in the dividend, it could do pretty well. So I would keep this Dow dog. And let's look at the next one. Dow Chemicals, that's kind of it's kind of in the middle. Intel, I would say, is one that is down a lot, has a good dividend, is not going to zero. It has its problems, but I'm sure there will be some kind of bounce eventually, so I would keep this one. IBM is kind of already up a lot in the last few months, so I wouldn't really chase this. Walgreens looks like a pretty good candidate and still has a decent dividend. 3M also looks like a good candidate, although it does have the problem of them getting sued with their class action suit, and so that could be a headwind for them. Chevron is up a lot, and it looks like a double top to me. So although it's performed well, I don't think I would want to own this right here at these prices. So I would not keep this one. JP Morgan, also it's up a decent amount from a few months ago. It was $100. Now it's $135. I would not keep this. Amgen also is up a lot from its bottom off this 50-month exponential moving average of like 220 and went as high as 300. You know, it's a strong stock. I mean, look at it. It's not a bad stock to own. But in terms of something really snapping back from the lows of the last year, Amgen is probably not one. Cisco's kind of somewhere in the middle, bounced back off of like 38 and went as high as 50. So I wouldn't really buy this at this level. Merck is just a monster with a monthly breakout as the stock market is breaking down. So this is a really strong stock. Coca-Cola is not in the dogs of the Dow anymore. It's been swapped out, but again, this is also a pretty strong stock here. Goldman Sachs looks like it could be heading back down. Procter & Gamble acting pretty strong here. J&J, like Amgen, is just a strong, slowly uptrending stock, good long-term hold. Caterpillar is up a lot from 160 to 240. That's a 50% gain in just, 5 months. I don't really want to buy stuff that's that elevated, but it's acting pretty well here. Home Depot, not acting that great. McDonald's, again, just strong, slowly trending up. Travelers, also a strong stock. Honeywell, not bad. Walmart, also bounced from 120. American Express, this is a possible one I would add as kind of a dog of the Dow. It's not doing that great right now, but it could. UNH, also strong stock, elevated a lot. Didn't even touch the 20-period exponential moving average, let alone the 50. So this thing is really strong. Nike, however, was weak, but had a nice bounce off $80, so it's a little late to the game now to be buying this, I think. Microsoft looks like a pretty good candidate. It's right by the 50-month exponential moving average. The stochastic is just bottoming out. The MACD is already through the zero line, so this could have a pretty decent bounce. I would add this if I was picking 10 stocks from the Dow. This would definitely be one of them. Visa, not really. Apple could get interesting here, maybe around $100 or $90 or something like that. Salesforce.com, I would say that this is one that, although it's beaten down a lot, it's not going to zero, it's not going out of business. It's a Dow component and it's going to have a bounce somewhere. So I would probably say I would choose this as one of my 10 as well. Boeing, not really, but it looks like a pretty big double bottom here. And Disney, another stock that has done really bad but has no dividend. If it did have a dividend, it would probably be one of the Dow dogs. So I would probably pick this, scale in around 80 or 70 or something like that. But it's off a lot. It's a Dow component. It's not going out of business. It could have a little more ways to go down, but when it does snap back, it's probably going to have a decent snapback. So that's a look at what the dogs of the Dow are and what I would probably swap out with some of the other ones that are already kind of up a lot, like Chevron and Merck and that kind of thing. Let me know if you're considering using the dogs of the Dow strategy this year, and if you would keep it exactly the way the strategy goes of just the 10 highest dividend payers, or would you swap out with some of these ones that are really beaten down like Disney and Salesforce.com? Let me know your thoughts in the comments below. Thanks for watching, guys.